Barry, your take on the economy. Let's break this down.
Well, the economy is obviously stronger than people thought. And I think I want to just talk about the structure of the economy, because this is not my parents' economy, and it's not built that way. And that's why Powell is having such a hard time changing it. If you look at the employment market today and the year to date, what's happened in the employment market, there, 50 million jobs are in healthcare, government, and education. And you see that's the biggest bar chart on that page. And the third category of almost 100,000 jobs added this year is construction. You're not supposed to see that, right? You're not supposed to see that with a 500 basis point increase in rates. And these drops that I mentioned in multifamily and office and logistics dropping 70%. So his rates are not impacting this job market, and he's not getting the layoffs. Go to the next.
But can I just say very quickly, if he wasn't doing what he was doing, Jay Powell hadn't raised rates to this extent, where do you think inflation would be? Because all of this spending that was already baked in.
I believe it would have gone down on its own.
Okay. Why?
That's because the money was being worn out, and it was driven by a lack of supply on the shelves. I don't think he needed to do this. Maybe 300 basis points,
but
not
he's
500.
He's also battling a lot of fiscal spending.
Well, if you bring up the next slide, you'll see that what's happened since he started raising rates in the healthcare industry, which is completely insensitive to interest rates. You've added 3.2 million jobs in healthcare since May of 22. So he's had zero impact. 3.2 million positive jobs since May of 22 in healthcare. So obviously that's like, and you still have a nursing shortage. You're going to have more inflation, more people looking for jobs. The report this morning, the ADP report, showed there was another second category. Go to the next slide. This is the one that's completely shocking, which is construction. And this is where spending comes in.
Right.
It looks just like healthcare. We've added 1 million jobs in construction. You lost 1 million jobs in 07, 08 in construction. We've added them, even though he's increased interest rates 500 basis points. Why? Data centers, the transportation bill, the CHIPS Act, the infrastructure bill. So he's not getting layoffs in the part of the market that are most sensitive. This is the most sensitive employment category to interest rates, and it's going the wrong way. So his toolbox is not working. And
basically, he can't do it. It doesn't matter what he does.
He can't do it. Or he has to go after services, which is retail, lodging, hospitality, business trade. If he hits that, he creates a great recession. If he's going to knock those jobs out, which is a big category, he's going to have a serious consumer recession, which I don't think he can stop. And that's when he's going to have to get aggressive on rate cuts. So and the consequence of this is not small. The consequence is the federal government, and I think that was the last thing I had, is the biggest victim, because Rick Reeder is a guest of you all the time, right? He'll argue that high rates are creating inflation from BlackRock, right? He thinks that the excess, we're making $235 billion of excess interest income today. It used to be 70 billion consumers got when T-bills were low. Now it's 318 billion. 235 billion of excess interest income is going out and buying things like services. He'd argue that the show used to be $100 and now it's $300, right? Goods are going down, services are going up because consumers have excess cash from the savings they're getting, the interest income they're getting from all the cash they have in T-bills. So he's arguing that high interest rates are creating more inflation. So I think it's pretty interesting to see. And the government will spend, as you know, interest expense just passed defense spending.
Right.
And it's on its way, a third of our debt. So he can spend 4% on 13 trillion or 5% on 13 trillion. That's the interest expense on the amount of the debt rolling just this year. Half of our debt will roll in the next 3 years. So that's number one. The federal government's the biggest victim of his own problems.
Here's my argument with Powell is that he can only do so many things. He has two mandates. One is the inflation rate, the other is unemployment. Those are the two things he's supposed to be watching. You're right that he has a limited toolbox in what he can do.
Very limited.
I don't know that this is a fault of Jay Powell and the Fed, or if this is just there's only so much they can do, and there are all these other forces that are adding up.
It's a tough job, and with Congress spending money the way they are,
that would be my.
It's not, again, one arm of the government has their foot on the accelerator and the other on the brake.
Yeah.
And usually things explode when that happens. The engine wears out. I hope it doesn't explode. I mean, the U.S. economy is being powered productivity. A lot of jobs are part-time. They're not full-time. But I think he just has to be careful. And I think because of the housing market with 4 or 5 million home deficit, and that is the biggest component of CPI, this deficit that he's making ever bigger because housing starts are falling and we're not building as many units will show up in a couple years with higher rent growth than he ought to have. He ought to smooth it out, lower rates, increase construction. But, you know, he's got it's a tough thing. And then you have the regional banks. And don't forget, that's the second biggest victim here.
Yeah, one of the things people have said is that the economy is really good right now. The markets are really strong. The only thing that would cause the Fed to actually cut rates at this point might be if there's something that breaks.
I think there's
the
two
regional
reasons.
banks come into that.
It's the regional banks and the commercial real estate crisis that's coming, which is coming. I mean, you can see it. We don't talk about the office. The amount of non-performing loans coming to market is growing. And he's also impacted the whole world. We're seeing, you know, distress across Europe because heretofore they've had to go rates went up with ours.
Yeah.
They're going to lower rates.
For the first time ever in the euro, since the euro's been created, that they would lead us in rate cuts.
They don't have the CHIPS Act, the infrastructure bill. They don't have those bills that are powering our economy past theirs. And AI is, you know, the data center business in the United States is insane, and they can't play. They don't have gas, they don't have oil, and they don't have excess power. So the differential between the U.S. economy and our growth and Europe's is going to accelerate because of all the impacts in the coming decades of AI on commercial profit margins.